If you're considering making a backdoor Roth IRA contribution for this year, then I will walk you through how you do that and also what are the mistakes that you want to avoid when making this contribution. Welcome back. This is episode 176. In this week's episode, I'm going to cover contributing to a Roth IRA for 2023 if you earn more than the adjusted gross income limits that the IRS limits you to contribute to a Roth IRA for 2023 and beyond. And the way that you're able to make this contribution, if you earn over the modified adjusted gross income limits, is through what's known as the Backdoor Roth IRA contribution. Now, I know it sounds complicated, but it's really not. So I'll break down how it works and the mistakes that you must avoid if you're planning to make a contribution for this year or the years beyond. Now, I also, if you're listening to this, if you haven't gone over and checked out my YouTube channel, please go to YouTube and search Retire with Ryan podcast. And while you're there, if you could subscribe to the show, that'd be greatly appreciated. Or if you're watching, if you could subscribe, that would also be appreciated, so you can help me to continue to grow the reach of this information and of this show. So first of all, what is a backdoor Roth IRA? Well, let's start with normally how you contribute to a Roth IRA. So each year, you look at your modified adjusted gross income for that year. And if you're under the limit based off your tax filing status, then you can contribute the full amount to the Roth IRA for that year. And the amount you can actually put into a Roth IRA for 2023 is $6,500 if you're under the age of 50, and there's an additional $1,000 catch-up or contribution that you can make if you're over 50, bringing your total contribution to $7,500. So if you earn, as I said before, over the modified adjusted gross income that the IRS says if you make more than that, you can't put money into a Roth IRA and you still want to make a contribution, that's where you can possibly do the backdoor Roth. And for a single filer, if your modified adjusted gross income is over $138,000, that is the cap, then your contribution starts getting proportionally reduced until where you earn over $153,000, it's completely eliminated and you can't contribute directly to a Roth IRA. For a married couple, if you're filing jointly, your modified adjusted gross income limit is $218,000. And once you earn over that, your contribution starts getting proportionally reduced up to $228,000, and then you cannot contribute any longer to the Roth IRA. So if you earn more than that and you want to contribute, as I said before, that's where the backdoor Roth comes in. And if you follow the procedures, you can contribute even if you make more than the modified adjusted gross income limits. There is no income limitation, essentially, if you qualify and follow the procedures. So how do you get the money into the Roth IRA through the back door? Well, you actually contribute to a traditional IRA as a non-deductible contribution. And then you convert that money over to the Roth IRA after it's gone into the traditional IRA. So it's pretty simple, but there are a number of mistakes that can be made with this process. So let's talk about those a little bit more. So the first mistake that people don't know about is called the pro rata rule. So let me just give an example of that. Let's say that you heard about the backdoor Roth IRA, you want to take advantage of this, you don't continue watching any more of this video, and you just put the money into the traditional IRA, convert it over to the Roth, and think you're done. Well, that's not the case. What the pro rata rule says is that if you have any SEP or simple IRA monies in your name, you have to count those in the calculation when you make the conversion. So let's just say, for example, that you were planning to put in $6,500 into your traditional IRA as a non-deductible contribution, convert that over to your Roth, but you had other IRAs that when combined with your plan contribution for this year, $6,500, equaled $100,000. Well, you then need to divide what you're converting by the total amount you have in those IRAs. And so let's just say in our example, $6,500 divided by $100,000 gives you 6.5%. So that would be the amount of the conversion that would actually be tax-free. The other roughly 93%, 93.5% would be taxable. So that would mean that you're paying tax on your money twice. That's called the pro rata rule. So that would mean, because you're making a non-deductible IRA contribution, you didn't get a deduction on that contribution, and then you're converting that over to a Roth, you then pay the tax again. So if you're in a situation where you have any other IRA monies in your name, a rollover IRA, that's traditional IRA, a SEP, or a simple, you'd want to get those monies out of your name by the end of the tax year that you're doing this backdoor Roth IRA conversion. So how could you do that? Well, if you have a 401k plan through work, maybe you could possibly roll that money over into that plan. So if it's an old SEP or simple or traditional IRA from, let's say, an old job, you could roll that over into your employer's plan. That's one way. Another way is that if you're self-employed or have self-employed income, you could set up what's known as a self-employed 401k, and you could then roll those monies into that. If you're not self-employed, you could start a small business. Some people even suggest filling out some surveys online, and if you're paid for them, that qualifies as a small business, and from there, you could even set up a 401k plan. Believe it or not, there's not a lot of requirements that you need to make to set up a 401k plan for yourself. You just need to have self-employed income. Now, keep in mind that if you're going to contribute to this plan, it would have to be equal to any earnings that you've made from that business. But if you're just trying to get monies out of your name for the purpose of doing this backdoor Roth IRA, that's one way that you could easily do that. So mistake number 2 is that if you are going this route with a individual 401k, the providers that I would recommend, and there are probably others out there, but ones I have experience with would be Fidelity, Charles Schwab, Vanguard. These companies all offer what's known as a solo or individual 401k. So with these plans, there's relatively low costs. These providers currently, I don't believe, charge you anything to open the account. There's some paperwork you need to complete, and you might need some help with that. But once you get that squared away and the account's opened, generally they're not charging you an annual fee to maintain these accounts. And so with those accounts, if you're using these providers, they offer a lot of low-cost investment options. I'm a big believer in index-based investing. They offer a lot of those options, so that's also another way how you can help keep those costs lower. There are other providers that offer 401k plans that might be charging you a larger amount, could be hundreds, even thousands of dollars a year just for an individual 401k. You really don't need to be paying that at this point if you're doing it all on your own. So there's ways that you can reduce those fees. Keep in mind, however, though, with a 401k plan, even an individual 401k plan, if your assets in that plan get over $250,000, then and it's your own plan, you have to fill out what's known as a Form 5500. It's a tax form that you'll need to complete. So that's really the biggest hurdle if you're doing that, but the backdoor Roth IRA advantages could outweigh that. So mistake number 3 is not completing the IRS paperwork that goes along with doing the backdoor Roth IRA. So this is known as Form 8606. And I've seen mistakes made with people filling out their own taxes, not knowing they need to file this form, or even people using accountants. So what happens is anytime you make a non-deductible IRA contribution, it has to get reported on this Form 8606, as well if you're doing a Roth conversion. So that's why it's important that you report this information so that it's properly documented in case you get audited by the IRS, because the IRS in the future doesn't ever track your basis with non-deductible contributions. So with non-deductible accounts, you could put this money into the non-deductible IRA and never convert it. That is an option available. And the benefit of that is that any gains you would earn above and beyond that contribution would be tax deferred. But when they come out, they're taxable, but your basis is not taxable, meaning your contributions is your basis. So if you don't track that, the IRS has no idea, and you could end up paying tax twice. So that's why it's important that you fill out this form and you document what your basis is, and that you keep good records. Because if you lose this information, there's no way to get it back. So let's just say you didn't know you were supposed to fill out this form, and you've been doing the backdoor Roth IRA contribution for a number of years. You should amend your tax returns, and I believe you can go back 3 years and amend your tax returns. So make sure you're filing that, or letting your accountant know, hey, I made a backdoor Roth IRA conversion, so that they can note it on your taxes, because if you don't let them know, they have no idea. So mistake number 4 is not investing your money. So the Before, until recent times, the backdoor Roth IRA was kind of a gray area. People weren't really sure if this was an allowed transaction. And the IRS has something called the step doctrine, which says that if the sum of all parts are illegal, then the transaction is illegal. In this case, because it was a gray area whether or not you could do this backdoor Roth conversion, what people are suggesting is that when you make the contribution as a non-deductible IRA, that you let the money sit there a while until you then converted it over to the Roth, so that it didn't look like that was the reason you were doing this, right? That it was your intent all along to kind of skirt the law by putting the money in and then converting it over. Well, in 2018, luckily, Congress made it clear that this is an allowable transaction. So you can do it, and meaning you could even do it within a couple days. You could put the money into the traditional IRA, then have it converted over to the Roth, and it's okay if it's something that happens relatively quickly. So make sure that you not only do it quickly so that you get your money invested in the account, that is, but then when it's in there, make sure that you invest the money in whatever you're choosing, whether it's going to be index mutual funds or individual stocks or bonds, whatever it is. Make sure you're investing the money and it doesn't just sit there, because with some investment providers, your money is not earning interest, and you want to make sure you're not missing out on that opportunity. And also, the faster you invest your money, generally, the better off you'll be. So mistake number 5 is not having your traditional IRA and Roth IRA with the same provider. I would suggest whatever company you're going to use, you have both the traditional and the Roth with the same provider. It just makes it easy. Sometimes this process could even be done online, where you contribute online, you even convert the money over to the Roth online. So, using the same provider is going to make your life a lot easier and also make the paperwork of tracking this easier. Mistake number 6 is not realizing that these accounts are individual retirement accounts, meaning if you're married, maybe one spouse can do this process, but the other can't. So as we talked earlier about having a simple IRA account, that's one reason that this might not make sense for you. And if that's an active retirement plan, that could be a reason why you can't do this. But if your spouse doesn't have a simple IRA, that could be a way that they could do it if they're able to, if they don't have any other IRA monies in their name, or if they're maybe able to roll this money over into another retirement plan that wouldn't count as part of the pro rata rule. And mistake number 6 is that people forget about the fact that the SEP and simple count in this calculation, and they keep contributing to these plans. So if you're self-employed and you have the option, consider ditching the SEP or the simple and going to an individual K. For a lot of people, this is going to be a better plan. And if not, then maybe just leave what you have there, convert it over, and make sure you're not contributing on an ongoing basis. That could run you afoul of doing this in future years. So this isn't for everybody, but it is a way that if you're trying to get money over to the Roth side, that you can do it. Just make sure you follow the steps. And if you're going to do this for this year, you have to act fast, because this money needs to come out of these old retirement accounts and go into a 401k or other retirement plan by the end of this tax year, so that it doesn't get counted in your calculation. So as always, if you have a question, feel free to email me your question or submit your question, I should say, by going to retirewithryan.com and clicking on Ask a Question. Have a great week, and I look forward to talking to you next Wednesday. Take care.